Friends, we have discussed about various investment avenues. We have discussed about the features of a good investment. We also have discussed about the objectives of investment. And today I will discuss about the process of investment. Okay, so any investor, whether an investor has an idea of investment or doesn't have an idea of investment, he has to follow the process for to be a successful investor. So the investment process, it involves a series of activities that leads to purchase of securities or other investment alternatives. Investment process, it is divided into 5 stages. Investment policy, that is to frame an investment policy, then analyze the investment, then value the investment, then construct the portfolio, then evaluate the portfolio. So this is expressed in the form of chart. That is, to start with, an investor, he has to frame the investment policy. It is not the investor, the government or the investor, before he proceeds to invest, he has to formulate the policy. Why? Because for the systematic functioning of his investment, formulating a policy is a must. The essential ingredients of policy are the investable funds, objectives, and the knowledge about the investment alternatives and market. Investable funds. The entire investment procedure, it revolves around the availability of investable funds. You just think, without investable funds, you cannot invest. So that is what we have studied. We have studied about various types of investable funds, which is nothing but the investment alternatives that we discussed. The fund may be generated either through savings or from borrowing. If funds are borrowed, the investor has to be extra careful in the selection of investment alternative, right? So that is, you don't have money with you, but still you want to make an investment. So how do you make investment? You have to borrow, right? When you invest your money or the money that you wanted to invest, if you have borrowed it, you should be extra careful. The return should be higher than the interest the investor pays. That is, if borrowed money, you have to pay interest. So you have to make an investment in an avenue whose returns is higher than the interest that you have to borrow, you have to pay for the borrowed amount. Mutual funds invest their owners' money in the securities. Now, objectives. The objective, they are framed on the premises of the required rate of return. Depending on the required rate of return, your objectives are framed. And need for regularity of income. You also have to see whether you need regular income, and also based on risk perception. So that is, are you able to take high risk, or are you it is not possible by you to take higher risk? And also for need of the liquidity. Okay, so on these premises, you will frame the objectives of investment. The risk taker's objective will be to earn higher profits, that is higher rate of returns, and higher rate of return in the form of capital appreciation. But the primary objective of the risk averse investor is the safety of the principal. Risk averse means who doesn't like to take or assume higher risk. He is called as risk averse investor, and his objective would be the safety of his principal amount. But risk takers, whoever is ready to take higher risk, okay, whoever is ready to assume higher risk, his objective would be to earn higher rate of return in the form of capital appreciation. Then coming to the knowledge. The knowledge about investment alternative and markets also play an important role in the policy formulation. The investment alternative range from security to the real asset. The risk and return associated with investment alternatives differ from each other, and investment in equity is high yielding but has more risk than the fixed income securities. The tax sheltered scheme offer tax benefits to the investors. That is, investors should have knowledge about the investment avenues. The investor should be aware of the stock market structure and also the functions of the brokers. The mode of operations vary among BSE, Sensex, NSE, that is, the operations by different stock exchanges will vary. Brokerage charges also are different in different stock exchanges, and the knowledge about the stock exchange will enable the investor to trade the stock intelligently. So, an investment policy has to be framed based on the premises of the investable funds, based on the objectives of the investor, and also the knowledge about the investment and the stock exchanges. Once he frames the policy based on these premises, the next step is to analyze the security. Security analysis is done on market, industry, and company. That is, he has to conduct a market analysis, because the stock market mirrors the general economic condition. The growth in gross domestic product and inflation, they are reflected in the stock prices. The recession in the economy will result in the bear market. The stock prices may be fluctuating in the short run, but the long run they move in tandem, that is in trends, either upward or a downward trend, and the investor can fix his entry and exit points through the technical analysis. He has to conduct an industry analysis. Why? Because the industries that contribute to the output of the major segments of the economy will vary in their growth rates, and their overall contribution to economic activity also will vary. Some industries grow faster than GDP and they are expected to continue to grow like that. For example, if you take the information technology industry during 1998, it has experienced higher growth rate than the GDP. The economic significance and the growth potential of the industry have to be analyzed. Then also he has to make a company analysis. The purpose of company analysis is to help the investor to make the better decisions. The company's earnings, profitability, operating efficiency, capital structure, and management, they have to be analyzed. And these factors will have direct bearing on the stock prices and the return of the investor. Appreciation of stock value, it is the function of the performance of the company. Why the stock value will appreciate is because of the performance by the company. And company with high product market share is able to create wealth to the investors in the form of capital appreciation. Then the third step is valuation. Valuation will help investor to determine the return and risk expected from an investment in the common stock, that is in which he is invested. He has made his investment. The intrinsic value of the share is measured through the book value of the share and price earnings ratio. And simple discounting models also can be used to value the shares. The stock market analysts have developed many models, advanced modules for valuing the shares. The real worth of the share is compared with the market price, and then the investment decisions will be made. Future value of securities also could be estimated by using a simple statistical technique like trend analysis. The analysis of the historical behavior of the price will enable the investor to predict the future value. And next is construction of portfolio. It's not advisable, or it is not uh, advised to invest only in one type of investment. So there should be a portfolio of investment in order to hedge against risk and also to gain higher returns. For this, an investor has to construct a portfolio. What is a portfolio? It is a combination of securities. The portfolio is constructed in such a manner to meet the investor's goals and objectives. So, how an investor construct a portfolio? It is in such a manner that the investor's goals and objectives are met. The investor should decide how best to reach the goals with the securities that are available. And investor will try to attain maximum return with minimum risk. And towards the end of construction, that is towards the end of the construction of portfolio, he will diversify his portfolio and allocates funds among the securities. It is not that he has to just construct a single portfolio and keep quiet. He also has to look into the performance of the portfolio, and he has to revise its portfolio by diversifying his portfolio. So next is diversification, and the main objective of diversification is to reduce the risk and also uh, the loss of capital and also the income. A diversified portfolio is comparatively less risky than holding a single portfolio, and there are several ways to diversify the portfolio. That is, he can make a mix of debt and equity, he can make industry diversification, he also make company diversification. That is, what is debt and equity diversification? Debt instruments will provide assured return with limited capital appreciation, but common stocks, they will provide income, regular income and capital gain, but they will give that with assumption of higher risk. And both debt instruments and equity instruments are combined in order to complement each other so that the risk is reduced. So this combination could be made, that is, some debt instruments in the portfolio and some common stock instruments in the portfolio will diversify the risk. Then industry diversification. So industry's growth and their reaction to government policies will differ from each other. That is, if the government policies are strict and stringent, okay, so they earn lesser returns. But if the government policies are liberal, they will give higher return. Banking industry will shares. It may provide regular returns, but the capital appreciation is limited. The information technology stocks would yield higher return and capital appreciation, but the growth potential um after the year 2002, okay, it is not predictable as it was easy before to this, and hence industry diversification is also required to reduce the risk. Then company diversification. Securities may also diversify the companies within the same industry. So different companies, the securities of different companies are purchased for reduction of risk. Technical analysis will help investors to buy securities based on the price movement, and fundamental analysis will suggest the selection of financially sound and investor friendly investment. So the next is, once portfolio is constructed, you have to make a selection. Based on diversification level, industry and company analysis, the securities have to be selected. Funds are allocated for the securities that are selected. We use different models like Markowitz single index model, Markowitz portfolio selection. There are so many models that will help you for selecting the portfolio. Uh, Funds will be allocated for the selected securities. That is, for example, if you have selected some 10 securities, it may not be recommended to invest in all 10 securities. You would invest based on the ranks of the returns of some securities, and based on that there is a model called as Markowitz uh, optimal portfolio construction model, which helps you in guiding how much to invest in each security once you come to know which is your optimal portfolio. Then selection of securities and allocation of funds. Mm, and the allocation of funds and seals the construction of portfolio. Then next step is evaluation. So as I told you, once you construct and select a portfolio, you cannot go with that portfolio for a long time, because due to a lot of factors, the share prices or the investment instruments, returns would vary. Okay, so when you have selected the portfolio, some of the returns of the instruments would be very good, but after few months or few years, due to many factors, uh, changes in many factors, external factors, they would be the return would be less or even more also. So then you have to evaluate in the terms of whether your portfolio is performing well or it is not performing well. The portfolio, it has to be managed efficiently. The efficient management will call for an evaluation of the portfolio, and the portfolio evaluation is done under two stages. One is appraisal and the other is revision. The return and risk performance of the security vary from time to time. The variability in return of securities will be measured and compared. The developments in the economy, industry, and relevant companies from which the stocks are bought, they would have appraised. They have to be appraised. The appraisal will warn the loss, and steps can be taken to avoid such losses. That is, if you undertake the steps of appraising the performance of your portfolio, it will give the warning about the losses that you are going to face in future if you continue with the same portfolio, and hence you can take steps to avoid such losses. Once you have taken steps and once you have come to know that you are going to incur losses in future if you continue with the same portfolio, you can revise the portfolio. It depends on the results of the appraisal. Revision is dependent on the results of the appraisal. The low yielding securities with high risk, they are replaced with high yielding securities of lower risk factor. So how you are going to revise your portfolio? So you will find out which are the low yielding securities and which are at higher risk. Okay, so they are the low yielding securities, at the same time they are also at higher risk. So you can replace such securities with high yielding securities and with the lower risk factor. To keep the return at a particular level, it necessitates the investor to revise the components of the portfolio periodically. Okay, so these are the steps any investor, whether an investor has knowledge about investment or doesn't have knowledge about investment, whether he is an individual investor or it is a company or it is an entity, it is required to follow the steps of investment for your investment to be effective and efficient. That is, for your investment to yield higher returns with lesser risk. So friends, this is one of the important questions that you would expect in your final exam also. So be prepared for this question, and also I would suggest to give introduction about investment, and to write a neat chart about the process, and then to start with the process of investment by giving one or two lines of explanation for each step, and also the sub steps, and finally to conclude so that you could expect more marks. Thank you.